Welcome to the Investing Show, where we discuss the investing news that you need to know about and get ideas to help you make more of your money. I'm Simon Lambert of This Is Money. Joining me in the studio, I've got Ben Kumar of 7 Investment Management and Richard Hunter of Interactive Investor. Welcome, gentlemen. So, 2018 has started fairly brightly for investors, and in fact, if they had held on through 2017 and been mainly invested in the stock markets, then 2017 was a good year for them. So, should we expect past performance to indicate future gains, or is that the kind of warning that you might remember reading somewhere that you need to worry about? Ben, a look overall at the year ahead, first of all. Do we have reason for optimism? Are we in this sort of perhaps last stages of a bull market that can deliver some of the best gains? Or should we actually be thinking a bit more pessimistically right now?
It's interesting, if you look at history, a market going up 20% like the US market did last year, traditionally that doesn't mean a bad market the year after. Usually it's followed by more gains, maybe not of the same scale, but still positive. And I think that seems to be the consensus for 2018. Economic growth's good around the world, almost every region, maybe the exception of the UK, looking better than it was a year before. And company earnings are really, really strong. Few sectors struggling a little bit, but if you look at the drivers of growth, there is spectacular earnings coming through. So there's nothing that would tell you that companies aren't making enough money or growth's about to run out. So you should feel reasonably optimistic when you look at the macro and the micro company picture.
And if we look around the world, for example, so we've got the US still going well, still going good guns. We've got the FTSE here, we've seen some record highs at the start of the year. Europe, things are looking up. If you look at emerging markets, which is obviously a very broad category, but if we, for example, look either to Latin America or to Asia, both of those look to be doing okay at the moment. And again, Japan on the up. I mean, that looks on the face of it like hey, you can't lose wherever you invest. This all looks fine. I could put my money wherever and I'll do well. But do investors need to be a little bit more picky and about where they are putting their money and thinking, okay, what do I think is going to do well and why do I think it's going to do well?
Yeah, I think that's really important. You have to understand why you're investing anywhere. And just piling your money into the market and going all in as a first response is to be a little bit cautious on that. So when you look at places that maybe have the capacity to outperform, Europe stands out, and I think Japan stands out. Europe stands out because it hasn't caught up with the rest of the rally in the same way the US, arguably the UK has. We're not talking about European indices hitting all-time highs. We are around the rest of the world. For Japan, I look at Japan and I think people haven't talked about this market for 30 years. Japan has been unloved for so long. And then you look at some of the companies there, and when do they do well? They do well when global growth is high. And global growth is high again. People are ordering things, people are consuming, and that all comes back to Japanese companies making more and more money.
That's an interesting point, actually, because you could argue that there's almost something of a mirror there with the UK. Yes, it has made gains, and yes, it continues to benefit from the fact that obviously 70% plus of earnings of FTSE 100 companies, for example, are coming from abroad. But by the same token, it has certainly not kept up in terms of pace with some of the better performing developed markets we saw last year. And that could in itself leave it as a somewhat overlooked market and therefore still with room to grow.
And on that point, I think it's probably useful for people if we look at the two separate sides of the coin. You've got the value element of investing, haven't you? And then you've got the growth element and perhaps also looking at the momentum, just buy what's been doing well because it should continue to go up. Can you explain those two sides of the coin, Ben, for our viewers?
Yeah, sure. I mean, the idea of growth is you invest in a company that, looking at today's earnings seems fairly valued, but you look at the future and see incredible opportunities for growth. So the example would be something like Apple back in 2000, 2001. It wasn't really a stock that looked kind of attractive, it wasn't cheap. But if you looked and saw that they had this new thing coming out called an iPod and saw the potential for that, you're in it for the future growth. Value, on the other hand, is buying things that have been overlooked. I think Japan falls into that camp, and I think the UK is absolutely right. People have been put off by the politics, when in fact last year you should have completely ignored the politics and bought the FTSE 100. Same thing could be true again this year. Buying stuff for slightly cheaper than it's worth. It's how Warren Buffett is among the richest men in the world today.
And if you look at that value perspective, Richard, that gives you that little bit more headroom for something to do well, whereas it tends to be that if you're buying growth, or perhaps also if you're just buying what's done well, the momentum kind of thing, you're buying into something that is already expensive, isn't it?
Yeah, that's right. And we mustn't also forget income, of course, because, again, for some time now, equities have been the investment destination of choice in the absence of yields elsewhere. Even if the Fed do raise rates 3 times this year, unlikely the Bank of England will at this stage, they're going to continue to do it at a very gradual pace. So you're still going to have relatively low yields in that respect. And of course, we've said many times before, on a bad day, the FTSE 100 will yield about 3.5% on average across the index. And that's, again, as we've said many times before, without the wonders of compound interest and reinvesting those dividends. So all things being equal, a lot of these factors still do remain in play.
When you're looking at the opportunities that you mentioned earlier, Ben, so for example, perhaps the UK, Europe, Japan, are you looking there for active fund managers who can, go hunting for what they think will be the best performing companies, whether larger companies or smaller companies, or are you looking for index funds where you're just buying the market, or are you looking to blend the two depending on what you're investing in?
It's a bit of a blend, to be honest with you. Index funds are brilliant. Right? The opportunities out there for investors who don't really want to put their money in the hands of someone who may or may not pick the right stocks. Index funds are now cheaper than they've ever been, more widely available than they've ever been, and really, really accessible. However, there are really good managers out there. They tend, not always, there are some exceptions, they tend to be in areas that people are less interested in, that are less known. So I'm talking about the small cap section of almost every market. Small cap UK, micro cap UK, fantastic. No one really looks at it in a professional capacity. So if you are someone who's got an institutional mandate behind you, you've got the power of a big investment firm, you can go and look at these companies and pick winners. Same in the US, where lots of people have said for ages, active investing is dead because you can't pick the next Apple. Yeah, in the massive, massive companies, it's really difficult to do because 50, 100 analysts are also looking at it. You're not going to find anything anyone's missed. But if you go down to the micro-cap US, a little petroleum firm in the corner of Texas that may be undervalued, there are opportunities. Similarly, frontier markets, emerging markets, thousands of companies out there, many of them with no one following them, but they still have a stock price that can be over or undervalued. So in those kind of regions, there are active managers. There are also, it must be said, lots of active managers who don't do the work. And you need to be very, very careful that you don't pay someone for giving you what an index fund would have in the first place. It's about doing your due diligence and finding the guys who go out there, get to know companies, and then put them in their portfolio, often in size.
Mm-hmm. Now, one of the other things I wanted to ask you about was that obviously the stock market's been doing very well. The one thing that investors are being warned about at the moment is the bond market. Now, of course, they may choose to take that warning or not because they've been being warned about the bond market for a number of years now. I've lost count of the amount of times we've discussed this on the investing show. But the problem with bonds is that the yields are very low, the prices are very high. It's been driven up by quantitative easing and nearly a decade of super low interest rates. And as that reverses, the expectation is that bond prices will fall, bond yields will rise, and investors will ultimately probably take a hit or have much less headroom to make those gains. Yet, if we look at the Investment Association data, we are seeing UK investors, personal investors, ploughing into bond funds, continuing to plough into bond funds, top-selling sector of funds, yet they're shunning the UK stock market. In fact, they even, in the latest set of figures, started shunning UK equity income, which has traditionally been a big favourite. So what's going on there, and do we need to be worried about that? And do investors need to think twice before they put that money into that bond fund?
I think the important thing to have, particularly with bonds, also with equities, is a global focus. Yes, the situation in the UK, compared to all the other developed markets, is a bit more uncertain. We know there are Brexit issues hanging over us. Looking out the next 2 years, growth is going to be slow. So investors who only look at the UK think, I'm a bit nervous, I'm going to go to bonds rather than equities. Actually, what they should be thinking is, I should be in equities elsewhere around the world when it's growing so strongly. And the second part that many people do miss out on is, Generally, bonds tend to trade on a global interest rate curve. If the United States puts up rates, 1% overnight, it's unlikely that UK bonds are going to be unaffected by that. You could see rates rise, bond yields rise, and bond prices fall. So I get very nervous when I see data such as massive flows into bond funds, because it is not the safe haven that investors kind of traditionally think it is. Now, if you were buying just a single bond and you were investing it, you were happy with your 1.5% every year for 10 years, and we're going to get your bond back at the end, that's fine, go and do that. But investors look at their accounts every day, every week, every month, every quarter, and these bonds mark to market. So if you're buying something like a 10-year bond at a price of 120, when it's going to redeem at 100, that will go down over time. Investors don't like seeing that. So I would advise people to be very careful in investing in bonds. Understand why you're doing it, and understand whether you should be looking elsewhere as well.
Mm-hmm. And I mean, that obviously, Richard, is where the attraction of the income comes in, that the companies can deliver, not just UK companies, but companies around the world, and looking for those companies that don't just have a high dividend, it's they've got that dividend well covered, that they've been maintaining that dividend for a number of years, and hopefully that they're continuing to grow it, isn't it?
Precisely, and of course the other thing we've got playing in at the moment is the changing demographic in the UK. In the good old days, you would probably start to move out of shares and into bonds, perhaps as you retired, on the basis you wanted a retirement income rather than access or exposure to capital growth. It's very possible these days, not only might you still be working at 60, but you may well still be living until you're 90. So you can afford to take that slightly higher level of risk, namely equities, for longer. And of course, beholden and within that is that ability to get that equity income, which you can then decide either to reinvest or take it as income per se.
Now, there is one thing that I obviously have to mention when it comes to talking about where to invest in 2018, and that is cryptocurrencies. The Bitcoin boom, bubble, whatever you want to call it. There has been an absolute explosion, not only in the price of Bitcoin, which was up 1,000% last year, but also, I think, in the number of people who you are hearing talking about buying into Bitcoin and other cryptocurrencies. I've lost count of the number of conversations I have overheard from people in public places where they're talking about how they bought into Bitcoin or how they did this. What I'm also seeing from questions I'm being asked by people, some friends and things like that, is that there's a limited amount of understanding going on, perhaps even amongst what they're buying, whether they're actually buying the cryptocurrency itself or whether they're trading it on some form of trading platform, perhaps that uses contracts for difference or even spread betting or something like that. Where do we stand with cryptocurrencies? I mean, it's very difficult to unpick this one, but is it something you have to be thinking about investing in, or is it something you should be very wary about?
Okay, so the first rule of thumb for any investment, when whatever it is you should ask, what is this investment? Not should I invest, but do I understand what I'm investing in? If a new company launches, ABC company, I should go and find out what that company does. And like you say, that question's not coming from people. The question is, should I buy it? Now, I think investors have to be very, very careful, especially if they want to be thought of as investors, on getting into something just because everyone else is doing it. As you talked about momentum trades earlier, they can be really, really good things. Bitcoin was up 1,000%. Do you think it's going to go up another 1,000%? You might not. Are you prepared for it to go down 1,000%? Can't go down 1,000, it can go down 100 and you'll end up in the same place, 0. So how does that feel? For lots of investors, it feels really, really bad. And like you say, lots of investors don't know whether they're buying Bitcoin, a contract for difference on Bitcoin, a tracker that may or may not hold Bitcoin. The questions that investors are asking are often nothing at all. They just give the money over. And that's slightly worrying. I'm a little bit comforted by the fact that it is quite hard to get access in serious size to the cryptocurrency market. You have to end up doing some pretty strange transactions to things like bank accounts in Eastern Europe to really get access. So I think it's quite difficult for investors to pile into Bitcoin, and I would absolutely advise against doing that. As with any investment, you don't want to put all your money in one basket.
It very much falls into the realms of a gamble rather than investment, doesn't it? It's if you're risking money that you're comfortable losing, then okay, you know, but if you are overexposing yourself to this, this is all of your investments, all of your savings, and you can't afford to lose that money, then you need to be very careful.
Yeah, absolutely. Traditionally, we've had low, medium and high risk. I think it's fair to say at this stage, cryptocurrencies are uber risk. You do need to understand them. You need to understand whether you can get out of them if there is volatility and some kind of whether they're redeemable. And there still remains some debate in the investment community as to whether they're a financial asset at all. They're not regulated at the moment. They're not a currency. They're not a stock. They're not physical. And I think Ben's absolutely right. If in doubt, if you've got any doubt either about the investment or whether indeed you understand the technology and the hundreds of thousands of electrical mining hours that are being put into mining Bitcoin at the moment, unless you're really up to speed with cryptocurrencies, which no doubt will have a future when they're more understood, then it's probably best to leave that money either invested elsewhere or under your bed.
Gentlemen, that's all we've got time for. Thank you very much.
Pleasure.
Thank you very much for watching, and good luck with your investing in 2018. Goodbye.